For our Did You Know segment, we are going to talk about discount points. We visited this before, and I just thought it was appropriate to take a look at this, mainly due to the fact that we've been reviewing these mortgage rates. We are on a downward trend now for about 5 weeks, which is awesome. This is creating more affordability, which is great. Inventory still remains an issue. So how can we take advantage of this lower rate environment as it's continuing to decline, but manage ourselves to a budget? So we're going to talk about that today. Discount points are an effective tool where you can reduce your monthly cost by paying a premium up front for a lower interest rate. Now, this varies lender to lender based upon what we call the rate sheet, how the rates are posted for that day, what investors a particular bank has. I'm just going to talk to rate and what we are offering. We have over 85 different banks that we direct lend for. What that means for you as a consumer and for my realtor partners out there, what that means is our interest rates are wholesale, coming directly from the lenders who've given us the authority to lend for them. So when I take a look at an interest rate sheet, I am able to tell a client and a family that I'm assisting, well, your interest rate would be this, or you can pay X amount of dollars in discount points and realize a lower rate of this amount, and this generates X amount of savings for you, right? So let's actually put some numbers to this, not put variables on it. There's not really a rule of thumb. But discount points are typically, I can tell you categorically, they are a percentage of the loan amount that is charged at closing as a loan cost. So you're paying that premium up front for a permanently reduced interest rate. If you're getting an adjustable rate mortgage, like we talked about last week, discount points still apply there. It's just going to apply to what your interest rate is for that introductory period, 3, 5, 7, 10 years, whatever it may be. There's a benefit because in an adjustable rate scenario, we also talked last week about the caps. So if you're paying that premium up front, there's further down the line benefit of those caps now being enacted on lower rates because you paid the discount points for the lower rate for that introductory period. But for our purposes today, we're going to talk exclusively about 30-year fixed rate mortgages and what discount points could provide you. There's no one discount point equals X amount. It varies. It depends on the day. It depends on market activity. On Wednesday, one discount point could save you 0.25% on your interest rate. And on Thursday, it could save you 0.3% on your interest rate, 0.375%. Or it could be reduced. You could, maybe that one discount point only gets you, let's say, 0.125% lower. It depends on the day, depends on how the rate sheets are comprised for that day, and that's based upon current market activity. So let's take a look, and I'm going to make a couple assumptions here. Assumption number one, I'm going to do a comparison for you if you are getting a $500,000 loan. So I'm kind of gearing this to first-time home buyers with minimum down payment. We just talked about how the 2024 median home sales price in New Jersey was $560,000. So let's just say you're putting down $60,000 on that median sales price. Your loan amount is $500,000. I'm going to compare that to putting an additional $10,000 down payment versus putting $10,000 or $11,000, let's call it, toward discount points, and roughly what that would generate for you by savings on interest rate. So let's do it by the numbers, right? Let's say $500,000 loan at 6.5%, right? We were looking at the averages today. That's kind of close to where we're at. It's a little bit less, but let's just use that for our example. 6.5% interest rate on a 30-year fixed rate mortgage, $500,000 loan amount. Your principal and interest is $3,161. Total interest over 30 years, $637,722. A lot of money. That's if you go 30 years. Now, if you were to put an additional $11,000 down payment on that mortgage where you're paying a 6.5% interest rate, you're looking at $3,099 as a principal and interest payment. That means your total interest cost over 30 years is reduced by $18,742. If you use that $11,000 and you put that money toward discount points, and let's just say that gets you an interest rate at 6%. I'm making assumptions here that the market is such, but this is within the realm of possibility. Let's just say that those discount points go toward that. Your interest rate's now 6% on $500,000. Your monthly payment's $2,997. That is $164 a month savings compared to $62 a month savings that the additional $11,000 down payment got you. Your total interest cost over 30 years is reduced by $58,000. So overall, you can see that I'm painting a picture for you. Discount points are an effective way to manage a budget and also save on interest long term. We don't know when there's going to be an opportunity to refinance. I do not believe that it's prudent to expect and make part of your plan to refinance, mainly because there's too much volatility in the market right now. So what you have in the hand is something you should be comfortable with and something that you can sustain. Discount points are an excellent way to prepare yourself to manage to your budget. And this is a conversation that I have with families that I assist all of the time. I take a look at the money they're putting for down payment, and I provide them with their options to show, well, dollar for dollar, you can generate a little more savings monthly here. Also, to do a comparison and to save $164 a month, if $11,000 down payment additional yielded $62 a month in savings, you're talking about needing to almost put down more than double additional down payment when compared to just paying $11,000 for discount points in this scenario. Now, this changes with time, but showing dollar for dollar, there's a little bit more power. So if you are trying to manage to a budget, call me. Let's talk about some of the ways that we can discuss how to implement this as a strategy to maximize your buying power. If you're a prospective home buyer, make it part of your savings plan to have additional money for possibly buying down your interest rate. And what that will do for you is really help you, one, insulate yourself from market volatility. Let's say you're not paying discount points and you're expecting an interest rate of 6.75%, but then mortgage rates go up, but you really need that 6.75 to keep managing toward your budget. You can have a conversation with your mortgage professional. You can ask, oh, I want 6.75. What's the discount point cost for that? And then you could put that in. Then you could see what that looks like. So have a little bit of a buffer. Have a little bit of a buffer prepared. You're going to be better prepared to manage to your budget in that way.